Hey Fools, I'm David Hansen, today joined by Fool contributor Jordan Wathen. Jordan, we're talking BDCs, business development companies, and more specifically, BDCs versus REITs. And there's people out there saying that BDCs are the new REITs, a lot of similarities here, high dividend, they have to pay out their income. Are they really the new REITs? Is this the new asset class for income investors?
I'm not sure it's a new asset class for every income investor, but I do think it could be an interesting asset class for a lot of income investors. And when you really think about REITs and BDCs are newer, obviously. REITs go all the way back to the 1960s. And so people look at this and they think, well, if REITs ramped up so quickly, so they grew real quickly through the 60s and 70s and then kind of died off and then blew up from the 90s to now.
Yeah.
They're saying, well, BDCs are there too. And Ares Capital Corporation actually kind of makes a good argument for this because they showed in one of their slides that they suspect there's $250 billion of annual middle market loan volume.
And they would be interested in this area expanding. They're the largest BDC, so maybe they have the outlook that they want the industry to become, I guess.
Right, exactly. So they see it out there, and when you compare it to the amount of equity capital that's out there right now, it's only about $40 billion in public BDCs. So the comparison there, it's fairly steep, the difference between what's out there and then what's out there in public hands.
Right.
And over time, I think you could see where early investors really benefit from being early on this trend, because we've only gone through really, if you want to count 2003 as kind of a cycle, and then 2008 is a fairly significant
definitely
cycle.
A cycle.
I mean, after the next one, and no one knows when it's going to be, but after the next one, I think you'll really start to see who's who in the industry and who can underwrite.
Right. And one of the things you see in both the REIT industry and the BDC industry is management, and whether it's external or internal management. External, basically taking a fee based on assets or shareholder equity, whatever it may be. You see that in REITs and in BDCs. With an internal BDC, is that growth, does that benefit them more than an external, or benefit the shareholders of that internally managed REIT, because the costs remain low as assets grow and income comes in?
Right. So I think for three BDCs specifically, Main Street Capital, Triangle Capital Corporation, and Hercules Technology Growth Capital, they're internally managed. So the more they grow and the more they can spread out those fixed costs on a bigger asset base, the more shareholders will benefit.
Right.
So coming out of the next cycle, if these guys underwrite as well as they have been historically, I think they could be leaders in doing that.
Right. I mean, I guess that's the biggest question mark, right? Is the underwriting capabilities. How much faith do you have in the management to make it through that cycle? Because if they make bad loans and all their companies go belly up, or a vast majority of their portfolio, then they're not going to make it through the cycle there. So that's really what you're betting on here, is the management team, right?
Right. It's always a jockey play. And when you think about it, REITs go back to the 60s, BDCs go back to the 1980s. So it's, they've still got a lot of catching up to do.
Still maturing a little bit.
Yeah, definitely.
All right. For Jordan Wathen, I'm David Hansen. Fool on.